Hi everyone, this is Jason Birack of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. He's joining us from England. Alasdair Macleod is head of research at Gold Money. He first became a stockbroker in 1970. He was a member of the London Stock Exchange since 1974, and he has experience in equity and bond markets, fund management, corporate finance, and investment strategy. Thank you for joining us again, Alasdair.
That's my pleasure, Jason.
Now, Alasdair, you've put out some very interesting pieces in the last number of months, and we have a lot of people in the gold and silver community arguing about whether or not China is going to announce their gold reserves update soon. Where do you stand on this issue?
It's an interesting question. I think it might be helpful if I just give you a little bit of the background to where she is and what her strategy is likely to be, in my opinion. Basically, the Chinese government acquired the bulk of its gold by 2002 when it permitted its own citizens to start buying through the Shanghai Gold Exchange, which was set up in that year. So the gold position held by the Chinese government has been very large for a very long time. And I've done some fairly detailed research as to what the position is. And I think it is quite likely that before 2002, they had accumulated a figure like 20,000 tons. Now, to back this up, I can tell you that in the prices of the time, this is quite likely because China was neutralizing capital inflows initially as Western corporations were setting up factories in China. This was in the late 80s and early 90s. Time went on, China's surplus started growing, and she was trying to keep the renminbi down, and that led to the acquisition of dollars, and I would argue that it made sense for her to acquire more gold at that time. So if you look at that aspect from China's point of view, it also makes sense. The other thing is that there was something like, on my figures, 75,000 tons of new mine production, sales from the West, because portfolios were reducing their positions between 1983 and 2002, and you had leasing as well. All these factors come together. You have a figure like 75,000 tons of supply. The big demand was in the Middle East. India only started kicking in after the Gold Control Act was rescinded in 1992, and from that time to 2002, she imported, allowing bit of smuggled gold, a figure like 7,500 tons. So you can see that that the numbers do stack up. That China acquired a very large amount of gold in those years. Now, why she did it? I think, firstly, one of the reasons she did it is rather similar to the reason that the Arabs acquired gold. They wanted to have something tangible, which had sort of long-term stability to if you like, for future generations. I think it was that sort of thing. I think it also slightly to, well, we've got all these dollars, we don't want dollars. Remember, this is before the euro as well. The only currency that they could really have was dollars or gold. So that was another reason to acquire it. And in 2002, something else happened. China, with Russia, set up, or it formalized with its original charter, the Shanghai Cooperation Organization, and that was in 2002 as well. So at that point, I think the strategy changed. I think Russia and China from that time started thinking in terms of their strategic direction. And where we are now in terms of that strategic direction is that China has a big credit bubble, which it is trying to deflate. And the credit bubble has been occurred, I think, on the back of an enormous amount of export business to the West, which, of course, has created, if you like, internal bubbles in the Chinese economy. And what she is trying to do is she is switching from that emphasis into developing Asia's infrastructure, and that is why she set up the Asian Investment Bank. the amount of money that is likely to be spent over the next 20 years will be a figure like 15 to 20 trillion. And over the 30 years, I think you're looking at 25 to 30 trillion dollars equivalent in today's money being spent on infrastructure. So it is quite clear that China's economic path is to evolve away from the West towards the Asian market, which she sees as her own purview, as it were. And we're talking about roughly half the world's population, if you include India in, and I know India and China don't get on terribly well, but that's where Russia comes in, because Russia handles that relationship. And also China has pretty well a monopoly now in terms of commerce with sub-Saharan Africa. So she's tying in Africa as well. So there is this huge, great new direction, and it's also taking Europe in. I mean, this is why Britain joined in, was one of the founding members, I think the first founding member of the Asian Infrastructure Investment Bank. So if we just put that to one side, we now understand why it is that China, or how it is that China intends to move away from the bubble, which is now deflating, which was based on Western trade, into refocusing into infrastructure. Now, I think that coming to your question, that's the background which gives us, if you like, the strategy to your question. Since 2010, well, in fact, I think earlier than that, but 2010, the IMF said no to China when it came to including the renminbi in the SDR. The SDR, for your listeners, is comprised of the dollar, the euro, sterling, and the yen. Now, since then, it is quite clear that the if you like, the qualifications for the renminbi to join the SDR are now in place. But the problem here is, initially, the first problem, which of course I think most people are now aware of, is that America has tried to block the renminbi going in for her own strategic reasons. And it looks like that is going to continue to be the case. But there is another problem, and that is the direction in which Russia and China are going with the Shanghai Cooperation Organization tells me that cross-border settlements are going to involve gold in some way. Gold will be used, if you like, to give currencies credibility when it comes to cross-border trade throughout Asia. Now, the problem with the SDR is you cannot have a paper currency in there which has any degree of convertibility into gold. So you can see from that point of view that China is moving away now, or will be moving away, from its desire to be included in the SDR. And I think that the recent moves, if you like, to go in that direction have been, if you like, for form's sake. I don't think they expected it to go anywhere. Now, what that basically means is that in the fullness of time, the new BRICS Bank, which has been established in the last few months, will probably issue its own SDR, which will be, if you like, targeted at Asia and the main trading partners with Asia. And in that sense, I think we're looking at countries like Brazil in particular, South Africa to a lesser extent, and possibly even countries like Chile and Argentina. In other words, this, if you like, in the past has been seen very much as America's back door. And now the new SDR that the BRICS Bank will issue will have, and we don't know quite how this is going to work out, but it will have a gold content in it. And that will differentiate it from the IMF's SDR. Now, when that happens, you've got two SDRs, or two similar supercurrencies, one of which was backed by gold or has a gold element in it, and one which is pure paper. Now, that, I think, is going to disrupt the status quo quite substantially. So that, I think, gives you a pretty comprehensive answer as to where I think the strategy is going, what China's game plan is, and why it is that Russia as well is rapidly accumulating gold. And by the way, I think Russia probably has more gold than she has declared. But the signs coming, I mean, we're being told this, for goodness sake. If you read the informed sources from China and also from Russia, I mean, we're being told this. So, they know that the West is in a state of currency collapse eventually. And they want to insure themselves against this. They don't want to be part of that collapse. Nor, incidentally, do they want to trigger it. I should make that point as well. So I hope that gives you a fair idea.
Those are some interesting points. In terms of the 20,000 ton number, that doesn't count the private sector, any of the private sector gold that China has accumulated, right? That's just People's Bank of China from your number?
That's correct. And that is People's Bank of China before 2003.
And you don't think, do you think that they're buying on the Shanghai Gold Exchange right now? Because I know Kuz Jansen and Bullion Star has put out a number of articles recently, and he thinks they're not really buying that because, they have this enormous dollar holding in treasuries, and they would have to buy, I think, on the Shanghai Gold Exchange in RMB. So it doesn't make a lot of sense for the Chinese government to buy gold in RMB. They'd want to get rid of, their dollar in treasuries instead on the LBMA.
I think he's absolutely right on that. There is, I really do not see any reason why the Chinese government should buy gold through the Shanghai Gold Exchange. I think that basically is an outlet for domestic private sector use. Now, whether China is acquiring gold in London or wherever through the People's Bank, other than that, I don't know. I suspect probably not, because the whole reason that she permitted her own people to start buying gold is, I mean, what makes sense to me is that she actually had, at that point in 2002, sufficient gold for the state's purposes, whatever those purposes might be. Now, the other thing about this is that she is now the largest gold miner in the world, producing something like 450 tons. The Chinese government the state owns all the refining capabilities. She imports gold concentrate and silver concentrate and doré from elsewhere. So, very obviously she refines, I think, everything that comes out of Mongolia, but also increasingly she's refining stuff coming out of Africa as well. So you can see that there is a substantial amount of gold building up in, if you like, in refined terms. Now, what happens to that gold? Now, I was given a clue on this, and when I spoke to the refiners who have refining capability out in Hong Kong, I asked them a simple question. Have you ever seen a Chinese government refined 1 kilo 4/9 bar? And the answer was no. Now, that's fascinating. I asked exactly the same question of our vaulting partners in Hong Kong. Have you seen a Chinese government refined 1 kilo 4/9 bar? The answer is no. Now, either the control of gold at the border is so efficient that none of it gets out, or the government is taking it all. You can make up your own mind which you believe. As a rider to that, when the government produces statistics and things like that, I don't think the Chinese government is any more honest than the US government. And bear in mind that the US government has not audited her gold reserves ever. So you can see that we know
not since the 1950s, right? Well, I guess
absolutely.
There was an audit then.
I mean, exactly that.
But that's so long ago that it doesn't count.
Exactly that. So the idea that the Chinese government are entirely honest with us and all the rest of it, you can forget that. I mean, they can make up the numbers, any numbers they want. I mean, that's the whole point about it. So you can research what goes in and out of the Shanghai Gold Exchange. You can, sort of get the numbers, trying to balance and all the rest of it, and you'll make them balance, but it's completely meaningless.
Yeah, I think I'm friends with Eric Dubin of News Doctors and Silver Doctors, and he thinks China is going to come out and just announce an arbitrary number just to get SDR inclusion, because I don't know if they want to take apart the IMF from the inside or what, but they want to be included at least temporarily in the SDR basket. I don't know if they want it permanently, but they may do it just for the short term, where they'll come out and announce that they have, 3,000 to X number of tons, somewhere around Germany's number maybe, of gold, even though I think there's a lot of evidence, like what you said, that they have a lot more gold than, if they announce they have, 4,000 tons or 3,500 tons of gold or something.
I think I would disagree with Eric's conclusion on that one, because, as I said earlier, I don't think her focus anymore is to be included in the SDR basket. I mean, if she is included, then fine. There's no skin off her nose. But she is changing strategic direction. And not only that, but when it comes to gold, you cannot have a paper currency in the SDR basket which has any degree of convertibility into gold. That is forbidden. So you can see that this isn't going to happen if China has a role for gold as far as her currency is concerned. And I would say that the strategic positioning through the Shanghai Cooperation Organization is so blatantly obvious that one thing we can conclude is that gold is going to be involved in cross-border settlements. And that does mean that there is some tie going to occur between the Chinese renminbi and gold. It's therefore not going to work at the SDR level.
Now, China, India, Russia are buying up more than 100% of global annual gold mining supply, and the miners seem to be in a lot of the primary gold miners and the copper miners now seem to be in a lot of bad financial position. Where, in your opinion, is all this gold coming from that's going to China, India, Russia, and the Middle East?
Well, it's coming out of Western portfolios or investors or whatever you like to call it. I mean, part of the management of our expectations is not only to have the bond market looking buoyant and stocks looking buoyant to create a feeling of wealth, if you like, amongst the middle classes, but also what you want from a central bank's point of view is to ensure that the feelings of risk also diminish. And in that sense, given that gold is some sort of marker about currency risk, then I think you'll find that the central bank's approach to gold is to discourage a build-up of ownership. Now, we basically in the West, we are not buyers of things because they're cheap. We buy things because they're going up, and that is reality. That's the difference between our approach to gold and the Asian approach to gold. So if we see gold going down, then we just don't buy it. If anything, we probably short it in the futures markets, and that is basically what has been happening. The result is that there is not only gold, but all markets have become so mispriced that at some stage there is going to be a reset. And I think that reset is not going to be, let's say, a gradual process. I think it could actually happen quite quickly. And for someone like me in the gold business, I think that's a great pity because obviously, we like to have a decent bull market, 2 or 3 years of rising prices. But I think that it's going to be the sort of thing where you're either in or you're out, and if you're out, tough. So I would tie in the future movement of gold to what happens in the bond markets and equity markets, and therefore currencies. In fact, we're beginning to see something developing in currencies because the yen has now comprehensively broken the 123 level. The euro has got the Grexit, if you like. That's becoming a very urgent consideration. So we've got a number of things which are driving the dollar higher, but they are ultimately very destabilizing.
Now, I had James Turk on a couple of months ago and with John Rubino, and we were talking about the money bubble. And I asked James if he thinks the crack-up boom has started because we're seeing, these. You talked about the asset prices. It's not just stocks and bonds. It's real estate. It's art. It's diamonds. It's collectibles. It's rare collectibles. The really, really rich. I don't know if they're going into a lot of physical precious metals yet. They're really, really rich, but they are going into hard assets and other things that can at least maintain some value. Do you think the crack-up boom has started, and do you think that the people in power are determined to keep asset prices rising no matter what? I
think it has started for the very rich. I mean, you just put yourself in their position. If you find that over the last 10 years, suddenly you've become a billionaire, what do you do with the money? Are you going to sort of sit on paper money? I think the answer is no. You probably buy the yacht, you probably buy a really nice house here, another one there, another one there, and then you still got a hell of a lot of change left over. What are you going to do with it? I mean, are you going to, invest in bonds for no return? Equities are wildly overpriced. In any event, if you made $1 billion, you've probably already got an awful lot of equity anyway. So, one way and another, I think the answer is yes. There is the crack-up boom, if you like, is visible in particularly the fine art market. When you see, contemporary painters' works being sold for, upwards of $100 million, that is crack-up boom stuff. And I think the point is worth making a point about the crack-up boom. I mean, for those of your listeners who don't know what a crack-up boom is, that is the moment when people finally ditch currency. They realize that it's currency going down, not prices going up, so they don't want currency. They switch their preference towards actually owning things for the sake of owning them and not owning currency. But as a process, the crack-up boom doesn't necessarily happen to everything at once. What will happen is that certain people will start applying this logic to certain things. And I think that's what we're seeing with the mega rich and the art market.
Yeah, I agree. I think the crack-up boom is a long and slow process, and I think we're in the early stages right now. When I talk to middle-class people in the United States, they have no clue. No. They see their stock account, they check their stock account maybe once a day, right? Their retirement account. And they check that, and their housing price, maybe their value of their house that they just got, maybe goes up a little bit every month or two, and they're pretty happy about that. And, they don't have any idea that all these asset prices are intentionally being inflated by global Keynesian central bankers, doing massive amounts of inflationary programs and things like that.
Yeah, no, that's absolutely right. I mean, I think the whole point, the reason that money is so useful to governments as a manipulation tool is nobody understands it. And we automatically think that, prices are rising. We don't actually think the purchasing power of money is falling, if you see what I mean. And if we woke up, because money has a role in transactions. It doesn't extinguish, it just changes hands. So when I buy something, I'm paying for it with money. The seller gets money, and he's going to spend that somewhere else, either in more production or, I don't know, whatever. So for that reason, we never actually think, we never understand that when we talk about inflation, price inflation, actually what we're talking about is the falling purchasing power of money. It's not rising prices.
Now, you wrote an article for Gold Money about deflation, and you don't think it'll last. I've researched deflation. I've studied the works of, Harry Dent and Robert Prechter. I've read their arguments about deflation and things like that. I've also read the Austrian school's opinion and definitions of deflation. I don't see the money supply decreasing. I see, central planners in the United States and Europe trying to come up with new schemes to create more credit bubbles, whether it's student loan, subprime credit bubbles, or subprime auto loans and things like this. Why, in your opinion, won't deflation last for a long period?
Well, I think you've said it. What's interesting is that every time government gets into this sort of position, the only way out is to accelerate the printing of money. And if at the same time you get a contraction of bank credit, they just merely accelerate the production of money even faster. I mean, this was exactly what happened after the First World War. In one of my recent articles, I made the comparison. Before 1920 in Germany, put it from the point of view of a resident in Berlin at the time, the flower of the country had been slaughtered on the fields in Flanders. You had reparations from France. You had, the post-war hangover, as it were, meant there was a slump in virtually every country. So when it came to exporting and so on and so forth, that way was also closed. Whichever way, there was no way that anyone living in Berlin in 1920 would expect prices to continue to rise. There'd been a bit of a rise sort of post-war, and you sort of think, okay, there's shortages of goods and things like that because distribution channels have gone, farmland has been neglected. So all those things are all good reasons why the prices of goods and services rose in the post-war years. But given the outlook, the economic outlook, it was quite clear to everyone at the time that this rise in prices was not going to last, and therefore you better hang on to your money. What actually happened was that within 3 years, the currency was completely destroyed. So the first lesson that we get in this is that we have been here before. At the moment we see the global economy tipping into a slump, or potentially tipping into a slump. I mean, the recovery never actually comes. So on that basis, you think, well, if we tip into a slump, then banks are going to have to close out their loans, and which means they sell collateral, which drives collateral prices down. Prices go down, money purchasing power goes up. So yeah, it's quite simple from that point of view. We're in exactly the same position as they were in Germany in 1919, 1920. And the other thing, of course, which bringing out your point, is that the thing that all these forecasters expecting deflation do not understand is that the production of money yet to be produced in the coming years is going to be considerably greater than we have seen so far. Why? Because the economy is not recovering. Bank lending isn't growing, certainly not into Main Street. It might be, sort of from time to time increasing into Wall Street. The result of that is that the central banks are going to have to cover for the contraction of bank credit. So we will get QE 4, 5, 6, whatever. It's going to continue. And the reason it will continue at an accelerated pace also is that as far as the central banks are concerned, we have managed to do QEs 1 to 3 without any inflationary effect whatsoever. When I say inflationary effect, I mean from the point of view of a macroeconomist who reckons that inflation is a rise in prices rather than an expansion in the quantity of money.
And they'll just change the formulas, Alasdair, for the CPI and for the GDP, and they'll change the deflator for the GDP, and they'll just change the CPI. They already have substitution, hedonics, and geometric weighting. So if the price of something rises too quickly in the CPI, they take it out. They take out the whole group.
Exactly.
So I mean, everything is stacked against them showing inflation, and there's a government incentive for them to want to cheat, especially in the United States, for cost of living adjustments. They don't want to pay out more and more money to the people who are entitled to benefits. But I've researched deflation a lot. Like I mentioned this briefly with you, but there's only been brief periods of time in modern history with quote unquote deflation. In the United States, I think it was 1929 to 1933, where there was some contraction there. With declining money supply, the banks weren't giving out loans. There was credit defaults. Prices were falling temporarily. But, when in 1933, they started stopping deflation very, very quickly with, Keynesian intervention programs, and that was it. Once 33 happened, FDR took over his economics people, even though he ran on a platform of free markets and basically like promising that he would be less intervention and that he would decrease government. He just went to a hardcore Keynesian program of stimulate, inflate, increase the CPI, come up with, new government spending programs, et cetera, and the CPI started, which is, I guess, evidence of inflation. The consumer prices started to, I think they were more honest back then, with a steady basket of goods. The prices started to rise. And in the other one is Japan, and, there's really no evidence that Japan, the consumer prices have fallen. Only asset prices have really fallen in Japan. And that's not Austrian school economics definition of deflation. That's just, they had a big credit bubble in the 70s and 80s and early part of the 90s, and it busted, and the asset prices haven't risen. They haven't had, a hardcore deflation, but we just hear it repeated so often. So when we hear these deflationists that, everyone should sell their gold and silver, gold's going to 10, or they just keep changing it, the numbers, what gold and silver, they're going to keep falling. I just think it's ridiculous because I don't think they've studied history to the amount that you and me have.
No, I think that's, well, you see, the other thing is that history sort of is written by people, particularly economic history, people who don't understand economics. What's interesting is that there was a program on BBC television a couple of years back where Stephanie Flanders, who was the BBC's economics guru at the time, looked at, if you like, the sort of the Keynesian economics and brought out the point about FDR. Now, what was interesting was her take on this was that FDR took over from Hoover, and then it was only at that point that they started reflating the economy and applying Keynesian economics to the economy. Now, this is completely wrong, because Hoover was doing it, and that was, and this is why, as you rightly say, in the election, FDR was talking about, the profligacy of the government, and, we've got to get back to free markets and all the rest of it. Because he was criticizing Hoover. And then when he gets in, he did exactly the same as Hoover. It didn't start with FDR. It actually started with Hoover. He was the guy who started that. And the amazing thing is that Stephanie Flanders was standing there talking about the creation of Boulder and the Hoover Dam, and how this was a project which had been done, if you like, by FDR's policies. I mean, for goodness sake, it's called the Hoover Dam. Who started it? I mean, your point is absolutely right. When they write economic history, they write it in such a way that it suits their predilections, and very often it's just completely misleading.
Yeah, and because the assets are being held with so much debt, there's so much stocks on margin, there's so much real estate being held with debt. There's carry trades on bonds. Pretty much almost every major currency, Alasdair, is being carry traded. That if the asset prices were to drop, too quickly, there would be enormous defaults and bankruptcies and counterparty collapses and things like that. So I think 2008 was a wake-up call to the central planners in power. I don't think they understood exactly how leveraged the system was. And, they did allow Lehman to fail. Maybe it was a sacrificial lamb. Some people think so, some people don't. But it seems, after that, they've pretty much determined that they're not really going to let any big bank fail or a big hedge fund that could potentially has a lot of counterparties and collapse the system. And one of the best ways to do that is to keep the asset prices propped up. And, as long as people don't know that there's inflation out there on Main Street, they can keep the inflation statistics looking a certain way. And that's not just the U.S., that's Japan, China, Europe, etc. So they could just, as long as most people don't really understand what's going on, they can keep the asset prices high in nominal value, and they could keep devaluing the currencies, and most people won't understand what's going on.
Well, the only thing I can say is that while that is undoubtedly true, there is an old adage in politics that you can fool some of the people some of the time, and all of the people some of the time, but you cannot fool everybody all of the time. There is going to come a point where this doesn't work.
Yeah, I completely agree. People are gonna notice at the grocery store or at the restaurant that their portion sizes are drastically dropping. The menu price. What I've noticed recently is that the menu price may stay the same at some restaurants, but the portion price, the amount of portion of food, is down 20, 30, sometimes even 40%. So that's what I've seen in the last couple years. One of the ways to offset the inflation that these companies are having in their global supply chain.
Yeah, no, I don't disagree with that.
Now, I want to ask you about Bitgold. It's very controversial. Gold Money is now, I guess, being bought out by Bitgold, or you guys are going to merge. Have you had a chance to look at the Bitgold technology and what it potentially democratizes the ability of people out there on Main Street who don't have necessarily a humongous amount of money, but they can go and buy a small amount of physical gold with their savings and diversify it, in different vaults. What's your opinion on the Bitgold?
Well, I think the first thing I should say is that I'm not part of the management, so I'm not privy to what has been going on, as it were. Now, I am aware of the deal, but it's not my position to comment. All I can say, I think, is that the one thing that Roy Seabag at Bitgold has managed to do is he's cracked the ability to run a debit card funded by gold, but which can either be funded or purchase things in multiple currencies, and that is really very, very clever. And I think that's a major step forward, because if you're going to, if let us imagine for a moment that paper currencies are destroyed or in the process of being destroyed, for you to have your money in precious metals and to be able to spend your money out of precious metals for the things that we need, day to day, is actually the ultimate holy grail, if you like, for anyone storing currencies. And I think that, my hope is that these two companies between them will be able to provide, if you like, a deposit base and the ability to do transactions. So that's, as I see it, is the logic in it, but I would rather not make any further comment other than that.
Sure. Yeah, Bitgold to me seems like, combined with the technology and the blockchain using the accounting, it seems like, the modern version of like the gold receipts or gold certificate, where the gold would be in the vault, and then the bank, in the past, the bankers, which were originally goldsmiths, they would just hand out, receipts, and people could redeem their gold on demand. And it seems like we've just applied modern technology to kind of make it that, although the government hasn't endorsed it that way. But banks used to be able to issue, their own gold receipts and store their gold, and they didn't need government to do that.
Well, what I would add to that is that the difference, if you like, between that old-fashioned system with the goldsmiths is that in this case you can actually see that you do have gold, you do own it, and the gold is yours. It is not bitcoins. You're not getting it's not like having a deposit at a bank. You have a card and it's actually backed by your own gold. And that is separate, incidentally. The two businesses are going to be run completely separately. Gold Money will continue doing what it's doing. And I'm sure that, the BitGold people, they are technologically on another planet as far as I'm concerned. I mean, they really are very, very strong in terms of their technology, their systems and all the rest of it. And I think they'll bring quite a lot of that sort of contribution to Gold Money.
Yeah, I'm excited to see how things turn out. The BitGold IPO has had a very exciting IPO, and it's backed by a lot of interesting investors with Sprott Investing, Ned Goodman, Nolan Watson, and Sandstorm Gold. So, and I think George Soros' son's also surprisingly invested too. That's a little curious, but maybe he sees the writing on the wall, right?
Well, I think as a separate comment, I mean, if you put yourself in the shoes of someone like Warren Buffett, he is so much part of the establishment. He dare not say anything other than gold is not money or whatever. Now, it doesn't stop him buying gold, doesn't stop him buying silver, and he has bought it in the past. And his father was a well-known gold, supporter of gold. So
libertarian, yeah, he was basically a libertarian.
Absolutely. So I don't think we should believe what people say for public consumption. See what they do, not what they say.
That's great advice. My final question has to do with potential gold shortages down the road and the gold miners. I look at the financial statements of many of the primary gold and silver miners, and a lot of them are barely treading water right now. We're talking if gold and silver prices, the paper ones, were to drop a little bit more, they'd be in jeopardy of having to shut down the mines. And there's really, when I talk to my finance contacts who finance miners, either in Toronto or Vancouver, there's really not much capital available. Are we going to see shortages based on some of these miners, closing down mines in the near future if the prices don't start going back up?
Well, you have two effects. The initial effect is that mines try and break even by mining the higher grade stuff in their reserves and accelerating, production. So the initial effect of a falling gold price, in particular, this applies to gold more than silver, I would say, is that it actually accelerates production of gold. But then there comes a point where, if the price continues to remain down for some considerable time, that actually what's happened is that the mine manager has damaged his reserves. And it's at that stage. So probably, a year or two after, you do have that effect. But in terms of the effect on the gold price, we're looking at what sort of 3,000 tons a year, slightly less than 3,000 tons a year being mined, whereas we have something close to 170,000 tons of stock. Sort of stock to flow ratios and all the rest of it, I think, what happens to gold mines and what comes out of them doesn't really have too much of an effect on the price of gold. Silver is slightly different because the bulk of silver is produced, I think, as a byproduct from other metals, base metals such as zinc and so on and so forth. So, and copper in particular. So, what drives the production rate of that is whether people are actually producing copper or zinc or lead, that sort of thing.
In terms of the stock to flow ratio, you mentioned it without mentioning it. You described what it is. I'm actually I don't think it matters as much talking with Eric Sprott and others who I've spoken to about this, because the gold market, it's not an enormous market, and a lot of the above ground gold, although there is an enormous amount of above ground gold, a lot of it is not readily available to hit the market. So I think it's maybe about 4,000 tons per year of gold that actually moves through an exchange, I think I've heard Eric Sprott say. So, the mining supply is a good percentage of that. So I think if the mining supply did come offline, there could potentially be a supply shock or a squeeze or something like that, because supply, a lot of the above ground gold is not readily available to immediately hit the market, especially at these prices.
Well, yes, I mean, there is quite a lot of truth in what you say. But I think there's, potentially there is quite a lot more than 4,000 tons. I mean, look at it from the point of view of Saudi Arabia. I mean, if Saudi Arabia decides that, she's got to make good, the fall in the oil price, she may well end up, say, finding a buyer or trying to find a buyer or getting someone to try and find a buyer, say for 2,000 or 3,000 tons. I mean, it wouldn't surprise me at all. And in that case, in the case of Saudi Arabia, of course, what they've actually got declared as reserves is a very small part of the total, and a lot of the gold in Saudi Arabia is privately owned. So, and private owners are subject to the influences that the rest of us are. You have an expensive wife or whatever, then you probably got to sell a bit of gold. Well, I'm exaggerating, yeah. But you know what I mean. It's
Or a divorce, yeah, and you're trying to move assets around, yeah.
Yeah, exactly. There could be a bit of that. So I'm not too sure that I would say it's only 4,000 tons. I think it's kind of unpredictable. I mean, getting back to China's acquisition of gold, which was over a 20-year period or a 19-year period, in my view, there was quite a lot of stock coming out of portfolios. If you have a handle on what was happening in Switzerland, there was a massive investment into physical gold in Switzerland in the 70s. In fact, actually going back before the 1970s. But particularly after that, you had heap leach mining technology came in, which accelerated the production of gold from a sort of 1,500 tons per annum to over 2,500 tons. The portfolio managers in Switzerland, from recommending at the time of inflation that you should have at least 10 to 20% of your assets in physical gold, they more or less sold it all by the turn of the century, by the year 2000. So there were, quite large flows of gold went out. Now, I don't think that we've ever sort of got all that back, but there's no doubt that, I mean, you could see with GLD just how much public interest there was in gold. This is a completely new market, incidentally, because in the past we weren't allowed to buy gold, and there wasn't such a thing as an ETF to facilitate it. And it was only really after the mid-70s that people were allowed to buy gold. Before then, as a stockbroker, I used to buy South African mines, American mines, Canadian mines, as an investment media to capture the move in gold. That was the way in which we did it. And so the whole world has changed, and I think these flows actually can be very, very significant.
Now, Alasdair, my final question for you, and you talked about not being allowed to own gold. If the gold price does, start to rapidly get either revalued or it does start to go higher every year again, the secular bull market resumes, do you think politicians are going to start to maybe debate either confiscating mines or putting a windfall profits tax on ownership of physical gold or outright banning gold. Do you think that's a possibility going forward?
Well, there's always a possibility because whenever you get a problem like inflation or something like that, the politicians always, even though they know it's wrong, start putting in restrictions and so on and so forth. And they know that at the end of the day, it's going to be worse. I mean, particularly controlling prices. If you get rising prices, what do? They bring in a prices policy, that you're not allowed to raise your prices. They always do it. They know it's wrong, but the political imperative is to do it. So that, I think, we ought to bear in mind. But
Or they'll blame the economic problems on the evil gold speculators, right? The evil gold bugs, right? It's all our fault, right? That the United States government is in debt and the British government is in trouble. And
the only thing I would say is that at the moment the level of gold ownership is very, very low in the United States and also in Europe, and so on that basis, I can't see any reason why they should bring in a policy to do that. The decision, I think, would probably be more in the hands of the central bankers. The central bankers, I think, would take the decision as to whether this is a sensible thing or not. And that decision, I think, becomes one of strategy. What is their position compared with other central banks? Is their physical gold out on lease? And if they take an action that drives up the price, will that make it harder for them to get their gold back? Or if they take a decision which will drive down the price, that might work for them. But I think if they started trying to restrict gold ownership, this would send a very, very clear signal to anyone out there that they've got to buy gold as quickly as they can. And I think it would create a stampede into gold and it would push the price up. And because that would work so much against Western central banks, I just do not see them advocating that course of action.
That's interesting. And it could also create an enormous black market for gold where the price is going up. So even if the U.S. government, and there's already high tax on U.S. citizens here for owning bullion when they try to sell it, there's no long-term capital gains tax where people can lock in 10% capital gains if they do sell some metal or something like that for holding it for more than a year or two. But let's say they try to put in another 70% windfall profits tax on gold. Congress has tried this in the past with the oil market. I think it would probably create a black market and people would go around the law and they'd be looking for ways to do transactions, probably not pay the taxes. So there would definitely be unintended consequences to Congress trying to do, wage and price controls and extra taxes and things like that going forward.
Yes, I think they are more likely to go down that route of, excess profits tax of some sort. As you say, I think it would just drive the whole business underground in a sense. But it's actually very difficult for them to do anything because everything is, since FDR's days, everything has become international. We have at Gold Money, we have clients from all over the world, customers from all over the world, and they store it all over the world. That couldn't happen at the time of FDR. And also the other thing is that back in the 1930s, we were generally more nationalistic. If the government said something, we would abide by it. I just don't see the same conditions today.
Yeah, I really think that in terms of the new technology and things like that, U.S. citizens can be tracked a lot more. I mean, I can't speak for people in other governments and financial data and stuff, but they're really, the U.S. government is really going after so much financial data of U.S. citizens. They have to report so many extra things that in terms of foreign bank accounts and FACTA and things like that. So I think for U.S. citizens, I think it's worse probably than most other countries in terms of having to report your assets all over the globe. So the internationalization, maybe if you're a citizen in another country, but if you're a U.S. citizen, you don't get that luxury. The way I see going forward after hearing about Edward Snowden and the data spying and stuff like that.
Yeah, no, I'd agree.
Okay, Alasdair. Well, I really enjoyed this discussion, and I think our listeners have some interesting things to ponder here. If they think that China owns, the People's Bank of China owns 20,000 tons approximately of gold, that would be very interesting because Jim Willie has said that too. I've heard that from other sources besides just yourself. So there's a number of experts out there who think this theory. Obviously, the gold market's very opaque, though, and I don't think they're going to go out and actually say, oh, screw you, U.S., we have 30,000 tons of gold. We don't need you anymore. I really don't think that's what China's going to ever do and announce, the full number publicly.
No, I think that's probably right.
Yeah, and it's really funny. We saw that Pravda article saying, oh, China has 30,000 tons and they're going to destroy the dollar and stuff. I don't think that's not really China's normal way of doing business and philosophy. They're kind of don't rock the boat, and, they believe in the art of war, and they like doing things with deception and slowly planning things.
I think that's right. And, quite simply, the last thing you do is get blamed for everything that goes wrong. You don't want to put yourself in that position.
Well, China and the U.S. have a symbiotic relationship still. I mean, the U.S. there would be people marching in the streets with pitchforks if there wasn't cheap goods from China at Walmart and things like that, right? So
that's very true. Very true.
Okay, well, Alasdair, how do people find your work?
Well, at goldmoney.com and financeandeconomics.org, O-R-G.
Okay, great. Well, thanks for your time, and hopefully the Gold Money and Bitgold merger goes well, and hopefully you get some stock options in Bitgold, and if you would have had them already, I think you'd be up 600% or something.
Well, thank you for your kind thoughts.